In recent months, China has significantly reduced its holding of U.S. Treasury securities, selling off a record amount of its U.S. debt. As of August 2023, China's holdings of U.S. Treasuries dropped to approximately $805 billion, marking the lowest level since 2009. This move has sparked considerable discussion and analysis among economics and policymakers as it signals a strategic shift in China's approach to managing its vast exchange reserves. China's decision to offload substantial portions of it in its U.S. holding carries significant implications for the U.S. financial markets and the global markets. The U.S. relies on foreign investment in its debt to maintain liquidity and keep borrowing costs low. A major player like China reducing its holdings can influence global interest rates, the value of the US dollar, and overall investor confidence. This move underscores broader trends towards de-dollarization, where countries seek to reduce their dependence on the US dollar in international trade and finance. China has long been one of the largest foreign holders of US securities, a position it has maintained for decades as part of its strategy to manage its foreign exchange reserves. Historically, China has accumulated large amounts of US debt to help stabilize its own currency and to support its export driven economy by keeping the yuan's value competitive against the dollar. At its peak, China's holding exceeded $1.3 trillion in 2013. China's foreign exchange reserves, which include US Treasury securities, are the largest in the world. The management of these reserves involve balancing securities, liquidity, and returns. In recent years, China has been diversifying its reserves to reduce exposure to the US dollar and to mitigate risks associated with holding large amounts of US debt. This diversification strategy includes investing in other currencies, gold, and strategic assets, such as those related to the Belt and Road Initiative. The current reduction in U.S. Treasury holdings is part of its broader effort to ensure the stability and profitability of China's foreign reserves amid the global changing economic conditions. Some key motivations for selling the U.S. is debt. Economic diversification. China's been actively pursuing a strategy to diversify its foreign reserve assets to mitigate the risks associated with holding such a large proportion of its reserves in the US dollar denominated assets. By reducing its holdings of US Treasury securities, China aims to decrease its dependency on the US dollar, whereby protecting its reserves from potential economic and political volatility in the United States. This diversification effort includes increasing investments in other currencies like gold, strategic assets aligned with China's long-term economic goals. The global trend towards de-dollarization has been gaining momentum, with many countries seeking to reduce the reliance on the US dollar for international trade and finance. China's been at the forefront of this movement, promoting the use of the yuan in cross-border transactions and investing in non-dollar assets. By selling US treasuries, China's contributing to a more balanced and diversified global financial system, which can help stabilize foreign exchange markets and reduce the systematic risk. When we think about geopolitical considerations, geopolitical tensions, particularly between the United States and China, have played a significant role in China's decision to reduce its US debt holdings. The issues such as the ongoing trade disputes, sanctions, strategic competition have created an environment of uncertainty and distrust. Additionally, the Russia-Ukraine war has further strained the global geopolitical dynamics, promoting China to reassess its financial strategies and reduce exposure to the potential U.S. leverage over its economy. Trade barriers and tariffs imposed during the trade war between the U.S. and China have impacted the flow of trade and foreign exchange earnings. As a result, China has few U.S. dollars to invest in treasuries, prompting a reduction in its holdings. This is also seen as a strategic response to the trade policies of both the Trump and the Biden administrations, which have continued to challenge China's economic interests. Another thing is the economic performance of U.S. treasuries. Over the past few years, U.S. Treasury bonds have underperformed, making them less attractive to investors, including China. The decline in bond prices and the relatively low yields have reduced the returns on these investments. This poor performance has led China to seek higher yielding alternatives to optimize the return on its foreign reserves. And finally, they want to support their local economy and yen. One of the immediate benefits of selling the US treasuries is the ability to convert these assets into US dollars, which then can be used to buy the yuan on open market. The intervention helps to stabilize and support the value of their own currency, especially in times of economic or trade related stress. By bolstering the yuan, China can maintain its competitiveness in the global markets and manage its economic growth more effectively. So, what are the implications of the sale? There's a potential increase in US borrowing costs. As China reduces its holdings of US securities, the immediate effect could be a decrease in the demand for US debt. This reduction in the demand can lead to higher borrowing costs for the US government, as it may need to offer higher interest rates to attract other buyers. Increased borrowing costs could, in turn, raise interest rates across the board, including for consumer loans and mortgages, thereby affecting the broader US economy. There can be effects on interest rates and implications for the US fiscal policy. Higher interest rates result from reduced foreign demand for US debt could have significant implications for the US fiscal policy. The government might face higher debt servicing costs, which could lead to an increase in budget deficits and potential cuts in public spending. Additionally, the Federal Reserve might need to readjust its mandatory policy to manage the resulting economic conditions, potentially impacting inflation and economic growth. Now, for the global financial markets, China's sales of the US Treasuries could influence global investor behavior by signaling a shift towards alternative assets. Investors might diversify their portfolios by increasing their holdings in commodities like gold and crude oil, which are perceived as safer or more stable investments during times of economic uncertainty. This shift could drive up the prices of these commodities and impact the global financial markets. Now we have to think about the roles of the BRICS nations. Other BRICS nations, such as Saudi Arabia, India, and Brazil, have adjusted their US debt holdings, reflecting a broader trend among the emerging economies to diversify away from the US assets. This collective move by BRICS countries can also amplify the impact on the US debt markets and contribute to the ongoing de dollarization efforts, potentially reshaping the landscape of global finance. What will the future trends be? Well, analysts predict that China, along with the other nations, may continue to reduce the US debt holdings as part of their long term strategy to mitigate risks and enhance the security and profitability of their foreign reserves. This trend is expected to persist as countries seek to minimize their exposure to the US economic and political vitality. The ongoing de dollarization efforts could lead to a more multipolar global financial system with increased use of other major currencies, such as the euro, potentially the yuan, in international trade and finance. This shift could reduce the dominance of the US dollar and alter the dynamics of the global economic power. In the long run, it may lead to a greater financial stability and resilience against localized economic shocks. These implications underscore the significant ripple effect of China's decision to sell a record sum of US debt, highlighting the interconnectedness of global financial markets and the strategic considerations of major economic powers. So, what does this mean for you? Well, China's sale of this record sum of US debt highlights several key motivations, including economic diversification, geopolitical considerations, and the poor performance of US treasuries, and the need to support their local currency. This strategic move has significant implications for both the US economy and the global financial markets. It could lead to an increase in US borrowing costs, influence global investor behavior, and contribute to an ongoing de dollarization efforts. The broader significance of China's move lies in its potential to reshape international financial stability and economic policy. As major economies like China seek to diversify their reserves and reduce dependency on the US dollar, global financial system may become more multipolar and resilient. The shift underscores the interconnectedness and the nature of the global financial markets and strategic maneuvers nations employ to safeguard their own economic interests. And just as China and other countries are diversifying globally, you should as well. And here at Global Citizen Life, we help our clients diversify globally so they are never stuck under the control of any one single government. By embracing global diversification, you can achieve greater financial stability and freedom, just as other nations do.